Welcome to Season's blog. The volatility illusion. Are volatility harvesting yields for everyone? Sophisticated primitives promising to harvest market swings are DeFi's new obsession. Volatility yield, upfront options premiums, dynamic hedging vaults. These buzzwords are all over the timeline. The promise? Turning crypto's signature turbulence into upfront yield by selling covered calls, cash-secured puts, or algorithmic delta-neutral volatility indices. It sounds like Wall Street rocket science, rebuilt on-chain. Retail depositors feel sophisticated, like quant traders running institutional books. But a structural trade-off underlies the high-tech marketing and complex math. For the average saver, volatility harvesting yields are built on a dangerous illusion. The real cost of sophisticated yield. Options and volatility farming sound like free money until you look closely at the mechanics. Strip away the financial engineering, and retail depositors stand exposed to three distinct friction points. Capped upside, the opportunity cost trap. When you sell covered calls to earn premium yields, you're betting that the asset won't go higher than a set price, the strike. But explosive upward price surges are common in crypto. If ETH or SOL runs 50%, the option goes deep in the money. You keep the small premium, but you surrender the massive spot appreciation of your asset. You've traded a 10% yield for a 50% loss in capital appreciation. Dynamic hedging failure, the negative tail risk. Delta neutral vaults, such as Risk's DHV, algorithmically trade spot assets to neutralize directional risk. But on-chain algorithms must execute transactions through standard block times, while flash crashes move instantly. During violent volatility events, the automated hedger lags behind, and delta-neutral safety turns into permanent capital destruction. Cognitive exhaustion and locked epochs. Retail participants are often expected to select strikes, manage option expiries, and understand complex math, while locking their capital into rigid, multi-week option epochs. So, far from being passive, these yield sources are highly complex and capital restricted, and they transfer the directional upside from retail savers to sophisticated options buyers. They're clearly not for everyone, and that's all right. The accessible alternative, simple liquid cash flow. Retail users mustn't be compelled to sacrifice their assets' upside potential or accept complex hedging risks just to earn yield. And with its hold-to-earn mechanism, Season's Yield 3.0 model ensures they don't have to unless they want to. Instead of wrapping assets in complex options vaults or trying to capture algorithmic arbitrage, we built a digital native, liquid cash flow system around a direct-to-wallet spot distribution primitive. This unlocks uncapped long-term upside, as node owners, that is, wallets holding 10,000 plus Cs, don't carry any strike or option contracts. They retain 100% of the assets in their own non-custodial wallet and get the full value of their token's price appreciation. Real economic activity fuels this mechanism, so it doesn't decay or vanish entirely in sideways markets. Unlike volatility harvesting systems, every C's transaction generates a 10% fee, which flows back to node owners as yield through the TTT module. And since the fee applies in both directions, even those who exit during bearish markets leave behind yield for nodes. Moreover, there are no locked epochs, gas-heavy harvests, or manual claims on seasons. Yield flows directly into the node owners' wallets twice weekly in 3 liquid assets. The protocol handles all the underlying swaps and asset management. The journey for holders is as simple and straightforward as it gets. Hold 10,000 plus Cs in your own wallet, get a constant cash flow in liquid assets like wrapped Bitcoin, WBTC, tokenized gold, XAUT0, and yield-bearing stablecoin, JLUSDC. Simple receipts are powerful and sustainable. While the options-based yield landscape has spent the past months navigating complex rebalancing and negative funding rates, Season's direct-to-wallet cadence has successfully completed 49 distribution rounds since December, week after week, without fail. $182,681 plus has already been distributed so far, with 0.248 plus WBTC, 3.99 plus ounce of gold, and 23,934, approximately $22,000, JLUSDC. Over $4,197 was paid in round number 49 alone, with an average APY of approximately 8.26%, nearly 2 times the current inflation rate in the US. The thing is, while volatility harvesting models certainly have their place in the DeFi yield stack, sophistication at the expense of retail upside can be a bad deal for most users, if not all, especially from a savings and long-term wealth creation standpoint. In a world where banks pay sub-1% interests and top high-yield savings accounts cap off at 3 to 4%, both unable to beat inflation, savers who are turning to crypto need reliable cash flows landing in their wallets automatically, denominated in assets that preserve their purchasing power. And in this context, derivative instruments with complex expiries are a nice-to-have for those with excess capital, not necessarily for those seeking steady but uncapped solutions to build long-term wealth. Simple in the front, sustainable in the back. That's what the next billion crypto users need. That's what Seasons provides with Yield 3.0, letting holders use their wallets like a savings account and access a constant liquid cash flow. Earn more, earn always. Earn Yield 3.0.